Hello, options traders. Welcome, everyone. And I want to give a special welcome to the probably 15 or so brand new members that we have in this group just from this week, and it's only Wednesday. So special welcome to all of you. And as always, trying to teach the art and science of options trading here, especially for all the new investors out there. There's a lot of things to learn, and I want to at least get people headed in the right direction. I started last week talking about some of the technical indicators, and I'm going to try to post some of the more common ones. And last week I did MACD, moving average convergence divergence. This week we're going to look at the stochastic oscillator. Now, another side note, why are we looking at so many different indicators? Because there is no reason in the world to use one. In fact, that's really a dangerous thing to do. You always want to use multiple. Don't get crazy and use hundreds, but use 3 or 4, maybe 5, and try to get confirming signals. Second point, do not use these as ways to try to flip back and forth between calls and puts and play all these little zigs and zags in the market. I'd rather see you use these indicators as ways to hedge, roll, and morph your positions. So let's take a look at the stochastic oscillator. First of all, let's take a little look at the history. This was developed by a man named George C. Lane in the 1950s, so it's been around for quite a long time. Now, don't let the word scare you. A lot of times people say, ooh, I'm not going to use stochastics because it sounds way too complicated. This is actually one of the easier indicators to understand. I'll show you in just a moment. But the word stochastics, or stochastic, is really a term that just describes a statistical process or a random process. So flipping a coin is a stochastic process. Rolling dice is a stochastic process. That's all it is. Specifically, stochastics is a momentum indicator that shows the current closing price relative to a range of prices. Typically, that range is a 14-period time frame. So what I mean by that, it could be 14 minutes, 14 days, 14 weeks, whatever, but it's generally a 14-period time frame. If you use longer periods, which you can certainly change in your platform, you will get smoother looking lines, but you're going to get fewer signals. That doesn't necessarily mean it's bad because the signals will probably be stronger and you'll get fewer false signals. So don't be afraid to get in there and experiment. But the basic idea is that you want to use a 14-period time frame. All right, let's take a look at the formula here. As I said, it sounds a lot more complicated than it is. You're going to be surprised at just how easy this is. But the formula takes two different lines, very similar to what we saw in MACD. There's one that's called a percent K line. And its calculation is we're going to take the current closing price minus the lowest point or the lowest price from that 14-period time frame. And then we're going to take the highest price found, not necessarily the highest closing price, but the highest price, an intraday price that occurred during that same 14-period time frame, and we're going to subtract out the low price. And we're just going to divide those out, and then we will multiply them by 100. There's a second line that is called the percent D line, and it is simply a 3-day moving average of the percent K line. Now, just a little trivia here. I know a lot of times people go, why do they call them percent K and percent D and all these weird terms? Well, there's actually a very long history of that, but when a lot of these were being developed, they came up with different formulas, and they very simply called them percent A, percent B, percent C, and worked all the way up the line, and they just kind of stuck with the ones that worked the best. So these were two of them, the percent K and the percent D lines. So once again, the formula looks complicated, but let me help you to visualize it and to see just how easy it is. Let's say that we had a stock trading for 100, and over the next 14 days, it has a high point at some time of 110. That's a $10 range. That's what's this portion of the formula, the high minus the low. We can think of that as the range during this period. However, let's say that today's closing price is 107. So think about what the formula is telling you. What it says is that we're going to take the current closing price and subtract off the lowest price that occurred during this period. Again, this is assumed to be a 14-day period. That's what this portion of the formula is showing you. What is the close minus the low? So here we can see that that is 7 points. So let's just say that that's 7. And then we're going to divide that by the high minus the low. So the highest point was 110. The lowest was 100. That's a 10-point range. So 7 divided by 10 equals 0.70. And of course, we just multiply that by 100, and that gives us 70. So if you think of this as a ladder moving from low to high, what the formula is telling you is that the current price is 70% of the way towards the top. So anytime that you see a stochastic indicator above 50, it just means that the current price is in the upper half of the range. If it's below 50, it's somewhere down in here. That's all it's telling you. So it's actually a very simple idea. Now, unlike the MACD that I talked about in the last video, the stochastic oscillator is bounded. And that should be fairly obvious. If you're looking at a range, it's either at the very bottom of the range, in which case the stochastic number is 0. If it's all the way at the high, it's 100%. So the indicator must fall somewhere between 0 and 100. That's what it means to be bounded. Can never be less than 0, can never be greater than 100. Now, obviously, it's going to be fairly rare to see a number of 0 or a number of 100. So what they do is they take ranges, and that's true for a lot of the technical indicators, and stochastics is no exception. And they look at ranges of 20 to 80, and that's usually used to denote the oversold and overbought levels. Of course, these can be changed. You can change them right in your platform to customize them according to needs, but the default will always be 20 and 80 for stochastics. So let's pull up the E-Trade platform and take a look at stochastics in action. All right, so here's the platform, and most platforms are going to allow you to put your technical indicators on your charts here. Might not be real obvious, but I can pretty much assure you that they all do that. So right up here for E-Trade, you can see studies, and then right down here is stochastics. And here's the default, 14. We can change that. We can also smooth out the curves a little bit so they're not quite so jagged. I can change the colors of the fast and slow. That is very simply the fast line is the %K line, the slow is the moving average or the 3-day moving average of the stochastic line. So just to be clear, the black line is our kind of that big formula that we saw, and the red line is going to be a 3-day moving average of that. I can also change the overbought and oversold levels. Again, the defaults, 80 and 20. If I check this box right here, it will actually show the 80-20 levels on my platform. So let's just leave these defaults, click on Save, and right down here is our stochastic oscillator. So what it's doing is it's looking back 14 periods, in this case 14 days, finding the highest high, subtracting it from the low, taking the current close from the low, and this just dividing those out. So for example, I've put these into an Excel spreadsheet. Here are the last 21 days. Now, today is the 27th, so I don't have the current market prices in here, so we're not going to be exact. But here's the way that it works. It's going to take, let's say, the first 14 days worth of data up here. And it's going to take our highest high right here, and it's going to take the lowest low. And again, let's just call that the range. And so I've got a number of 8.06. The current close minus the low is 2.7 right here. And if I take 2.7 divided by 8.06, I get 0.33 or 33 once we multiply by 100. Then what I'm going to do is I'm going to shift down a day. I'm going to look at days 2 through 15. And then I'm going to get 32. And so you can see up through yesterday, we got a reading of about 27. And right here, 28.91 in black kind of corresponds. Again, we're a little bit off because I'm not including today's information, but that's just to show you what this calculation is doing. It's quite easy. The interpretation is fairly simple. I've got a couple of ways, just like I did with MACD, based on the black and red lines that we're looking at here. So first, and probably the easiest, is to just look at the black line. And in fact, just to make it easier, let's go ahead and take off the red line like we did last time. So what we're going to do, this is my stochastic line. So a very basic reading is to just look at the stochastic oscillator right here, this line in black. Notice here are my 80 and 20 levels, these little horizontal lines. Anytime this black line is above 80, the interpretation is that we are in overbought territory. That does not mean you should expect the stock to be turning south. Not necessarily bearish. It just means that we are getting into kind of an overbought period. But remember that highs can go higher. Just like we did here, just because we're above 80 doesn't mean that we're necessarily turning south. And you can see that the stock price did in fact continue to run. So be very careful. Just because the black line crosses from underneath 80 to above it doesn't mean you simply want to go out and buy puts or turn bearish. It's just that we're getting into overbought territory. The signal comes when you cross from the high side down, such as right here. Or right here, cross from the high side above it down, that would be a bearish indicator. The reverse is true on the bottom side. Just because the indicator, look over here, dips down below 20 does not necessarily mean you should expect it to reverse and go up. What it means is that you are in oversold territory. Your signal would be right here when it crosses from below 20 to above. And if you look right here, gave a pretty good confirming signal. So that's just the basic way of using the stochastic oscillator, which is this black line. Let's go ahead and put our %D line back on. And again, that red line is just a 3-day moving average of the black line. So sometimes people will say, I want to see the moving average actually cross from the high side down. Remember, the moving average is going to be a little slower to respond, but it should therefore be a little bit more reliable. The main way that I like to use the moving average is this. If you're not quite breaking up above 80 or maybe down below 20, I will then resort to a crossover where the black crosses the red. So let's see if we can find a good example here. Maybe back over here. You see how this black line here, the %K, didn't quite get down to 20? So it never really gave us a signal because it couldn't cross from beneath to the high side. But we did cross the moving average right here. So I would then take that as the same thing as the black line crossing from below to above. That would be kind of our bullish indicator right there. Here's another one for the bearish side. You can see how the black line didn't quite get up above 80, so it couldn't go from above and cross down and give us a signal, but it did cross the 3-day moving average. The black line crossed the red right here, so that would then be kind of a short-term bearish signal. And that's certainly a point that you'd want to consider rolling your call options up. Bring those deltas down, but stay in the position. Sometimes we'll also do maybe a sell half and roll half type of a tactic, but the stochastic oscillator will help you to determine those points. Now, once again, to really get much better with technical indicators, don't just pick one. That's a really bad mistake. You want to get confirming signals, and that's why I'm going to stick with really the more popular ones out there, at least to get everybody started. So for instance, let's go back to MACD that I talked about last week. And we'll keep our defaults on here. And let's bring this up a little bit. I'm going to shrink down the chart just a touch. So what you want to do is get confirming signals. So this might be a point right here where we see the black line on stochastics crossing from below 20 to above. And look at this, it exactly corresponds, or pretty close, to MACD on a crossover signal. So that would give you a little more confidence that we're probably going to be turning bullish. And look at where it lines up in the chart. Lines up right there. Got this nice big bull run right there. So the main point is, understand how each of the technical indicators works, but then also use them in conjunction with each other, and you'll get much more powerful signals. So I hope that helps to get everybody started on the stochastic oscillator. And for those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course at optionsatoz.com. You can also instant message me here in Facebook. And also feel free to join us on the Facebook trading group, Options A to Z. We're going to talk lots about the art and science of options trading, great videos, great commentary. We'd love to have you join.